All right. Here we are once again this afternoon, Wednesday afternoon, ready to rock and roll with the markets as they rebound a little bit from this last 3-day little bit of a pullback. Not enough. I wanted it to pull back a lot more than that. Hopefully we'll get a better pullback, right? We want the market to fall. Come on. We want the market to fall. Why do you want the market to fall, Lan? Well, because I'm playing the accumulation distribution game and I need the market to fall so I can get back in. I think that just for fun, we'll pull up my little bit of a portfolio here. I don't know. I'm still in the middle of updating it and making some changes. So this is my portfolio, and you can see I'm getting ready to rebalance. I'm doing some rebalancing. And you can see that I've got about 200 in this account. I got $223,000 sitting in cash, and I've got another. Actually, that one's gone up. It just hasn't been reported yet. I think I got about 50,000 in cash in this one. So I got 50, 60, 70. I got about $275,000 just sitting on the sidelines, waiting to be put back in on my for my rebalancing. So I've taken a bunch of profits off and now just waiting for the market to rebalance. So that's what I'm waiting for. I'd like to see this market flush like a toilet. Wouldn't it be so nice to see it come all the way down here so we could get back in? That's what I'm looking for. There's your little Fibonacci ruler. You all think I'm crazy, but I'm not crazy. This is drive 1. This is drive 2. This is drive 3. Now, the problem is this little drive right here almost looks like it's just a continuation of this big long drive. Now this is the NASDAQ. So we're getting 3 drives in here on the NASDAQ in the futures market. In the stock market, that does just go together and we end up with 2 long drives. So we're getting a little bit of a conflicting information between the stock market and the futures market. Now, of course, this is the futures market out of Chicago. If we come down to the S&P 500, you can see that we got it's much clearer here. This is a nice 1 drive, 2 drive, 3 drive, but still, again, you get this little thing that you're almost like, was that really a break? But the whole market kind of went sideways for that month period of time, right? And then we got a little bit of a rally up in here, and it's trying to break higher right now. The thing is that we've been getting squeamish news, right? Kind of the rumor is that they're going to lower interest rates. And so we're looking down here at the 2-year and the 5-year. This is interest rates are actually going up. See that? So when interest rates go up, bonds generally, or stock market goes down. But we're getting a rally in the interest rates, and we're also getting a rally in the markets. So this little pullback here was from that earlier rally. So this was the rally that pushed that S&P down, right? But now we're getting a rally today, and the 2 years kind of pulled back a little bit from its highs. But if we go to the 5-year, it's kind of looks basically the same. So the 5-year and the 2-year notes in here are kind of our little bit of a giveaway. If they go up, the markets go down. If they go down, the markets go up. And so the market's not really been doing a whole lot here as far as the interest rates, right? They've been holding them steady. And so we just had some steady, a nice little steady trend coming in here. But usually what happens is the market does fake one direction, just like a good running back in football. It'll fake one direction and then go the other. So that's what I think everybody's anticipating. They're anticipating that the thing is going to pop up, test this previous high, which is what it's done here. Interest rates kind of run up a little bit before the Fed announces, and then it will flush down. It'll go. We'll see. I don't know. They've been saying that they're going to drop interest rates. I don't really think interest rates are too high. So I'm not in that camp where, oh, I got to get the interest rates down. Because if they take the interest rates down, then I make less money because I make a lot of money off my interest rates. A lot of people do. All right. But if you're an investor and if you're going to buy some property or, if you're going to go out and buy things, or if you're a business and you need to invest, it's better to have lower interest rates. Real estate, if you're trying to get into a house, it's not like interest rates are, everybody says they're really high, but they're not. We've had this discussion before. I've got a little chart and I should have probably had it ready for you, but I wasn't thinking of talking about this in this great of detail. But I wanted to have I wanted to start today with a little bit more of a gossip session. You guys want to do a little gossiping? I think gossiping's fun. All right. So we'll do a little gossip session here. about the financial markets and about Trump. All right. He's always good. He's always good for a little bit of gossip. Now, how many of you heard on the news that Trump was complaining? I don't know if he was really complaining, but he was stating that the banks, when he was no longer president the first time, they wouldn't let him bank his money. The big banks wouldn't let him bank his money. He had to go to little small banks around the country and just go to little state banks, because the big banks, Bank of America, and in particular, he talked about Chase Manhattan, right? Chase Bank. He was like, Jamie Dimon, CEO of Chase Bank, they wouldn't let me put my money in there. And he has a little story where he had to go around. He's like trying to put in, he had millions of dollars, right? Because he's a billionaire. He's got millions of dollars. So he was trying to put his millions of dollars around, and they said, well, they weren't going to let him in because who he was. He was Donald Trump, and everybody hates Donald Trump, and he's a Russian asset, and blah, 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 blah. You know the story. I don't have to repeat it to you. But they wouldn't let him bank his money. And so he had to jump through all kinds of hoops. And he's like, and, of course, they look into it, and they're like, well, all of these big institutions weren't letting a lot of conservative companies, conservative organizations do business. And I don't know if you guys remember that. If you're not in business, it might not have been something that hit your radar. My business isn't really controversial. I mean, I'm in the stock market, so the banks don't really. I mean, they should care, but they don't, because they're finance, right? So I'm in the right. I'm in the right club, right? I get the right club. So but they didn't like Donald Trump. They didn't like a lot of the conservative companies and things that they were doing, and so they wouldn't bank them. They wouldn't give them opportunity to put their money. They couldn't open up their money. Of course, it's the same thing that happens with if you're running marijuana. Remember when we were going back through the marijuana thing, and Obama and who was that last president? I already forgot his name. Joe Biden. We're talking about legalizing weed, and how none of the banks would allow the weed manufacturers to bank their money because it was a federal crime, right? But those guys were saying, oh, well, we're going to make it legal to go grow and sell weed in America. And so, stocks all went up, and we were all watching them. Oh, we're going to make all kinds of money. And then the banks wouldn't let them bank it. Well, they were doing the same thing to just because you were conservative, they wouldn't let you bank your money, just as if you were the same as if you were a weed grower doing federal crimes, right? So Trump's been running around, talking about that and telling his story about how they wouldn't let him bank his money. And of course, CNBC, was it CNBC or CBS? One of those big, name brand outfits got Jamie Dimon on the phone. Or actually, I think it was Bank of America. Was it Bank of America or Jamie Dimon? Because it was Jamie Dimon that Trump was complaining about. And, Chase Manhattan. But I think they got the Bank of America guy on there. Anyway, they were asking one of the CEOs if that was true, and the guy got on there and validated Trump, said, yeah, that was true. We were doing that. And so it really made them look stupid, right? And kind of had a little bit of egg on their face. But anyway, they ended up, I bet you anything this goes silent now, you won't hear a thing about it. It'll be real quiet, because actually it was validated that it was true, that that's what they were really doing, and they wouldn't let Trump bank his money. And so it's the headlines for, 30 seconds. Then as soon as they find out it's true, it's like, whoa, down low. Don't talk about that. So anyway, this is the hubbub that's going on out there in the world right now, right? So let's talk a little bit about that, because it's funny. All right, so I want to do a little chit chat here. I got something for you. It's kind of funny. So I did a little research over here on Perplexity. You guys know Perplexity. It's a great little tool. It's free. You can pay for it, and I probably should, because it's got so many. I really like this tool. It is really cool. It's a great, you know what? You have this. There is no reason that you have to have Google ever again. This little tool is so cool. It's a little search engine, but it's an AI system. So you just ask it what you want. You talk to it like it's a human, right? You just ask it questions, type it in there. It's got voice. You can even talk to it. You can't talk to it very much, because if you start talking to it too much, then you have to pay. But the free one even lets you talk to it. And mostly for as much as I use it, and I use the internet quite a bit, for as much as I use it, I haven't had to pay. They haven't, anyway, I'm not trying to be an advertisement for it. I'm just trying to tell, I don't make any money if you go use it. I'm just trying to help you guys out. It's a neat tool. You should use it. Perplexity. And there's a desktop version. So you can run it in your browser. It's just perplexity. I think it's perplexity.ai. It's not perplexity.com. Might be, I don't know. But I'm running the desktop version. You can go to their website, perplexity.something, and search it You're going to have to search it on Google to get it. But anyway, it's called Perplexity, and you can download a little desktop application, and you leave the icon on your desktop, and then you click on it, it pulls up this little program. So it's really cool. I like it. And anyway, I asked it. I says, was the CEO of Chase Bank in Saudi Arabia when President Trump went over there? Because I was like, he went to Saudi Arabia and he took a whole bunch of highfalutin, flanking CEOs with him to do business over there. And I'm like, did Jamie Dimon invited to that? And I asked the question, I said, was the CEO of Chase Bank in Saudi Arabia? And so it comes in and goes, there's no evidence that he was there. And so I said, well, who are the business moguls that went with him? And so it gave me a short list. It said, well, Elon was there, Sam Altman from OpenAI was there, Mark Zuckerberg, Larry Fink from BlackRock. I saw that one, and I was like, I saw him come through when they were shaking hands, because they did this big, long handshaking thing, right? And I was like, that's Larry Fink. Oh, my heck. They brought it Larry Fink from BlackRock. I said, watch the market go straight up, because they give Larry Fink a little bit. He's like the godfather of the stock market. I mean, you want the stock market to go up, kiss Larry Fink's hiney hind. So anyway, I saw Larry Fink there, and I was like, oh, market's going up. And then Palantir was there, and then Scale. I'm not sure exactly who Scale is. You guys know who that is? Andrew. I've heard of Alexander Wang. I don't really know what the company Scale does. And anyway, then it kind of just listed them off like that. And so I came down there. I said, can you list them all? Because I wanted to know if Jamie Dimon was invited, because Jamie Dimon wouldn't let Trump put his money in the bank, right? So I'm like, what's the politics going on behind the screen here? So there's just a little bit of, chatter. So the luncheon here, this is where it says, this is where all the big boys, I said, list them all out. So here they are. Elon was there. Stephen Schwann, Blackstone was there. BlackRock was there. I don't know who Anderson Horowitz. Anderson Horowitz. Okay. They were there. OpenAI, Franklin Templeton, IBM, Citigroup, Northern Trust was there, Boeing was there, Google was there, Amazon, NVIDIA, Palantir. All the guys that you would think would be there, right? Baker Hughes, Halliburton, Schlumberger, BDM. This one sounds funny. BDT and MSD. I don't know who that is. Bridgewater Associates. Not exactly sure what they do. Are they an investment firm, Bridgewater? Sheen. Not sure exactly who that is. Uber, General Atomics, Kirkland and Ellis, Enfield, an investment partner, Epic Games, Northrop Grumman, Coca-Cola, Uber. The mayor of Miami was there. Alco, Iron Mountain. That was a big list of CEOs, big falutin CEOs, right? I mean, that's quite a list. It's like, and then my question was like, okay, who didn't get invited? Who didn't get invited? So my question was, who are some of the obvious CEOs left out on purpose who should have been invited? And it comes in here, gives us this list. Tim Cook was not invited. Oh my hell. Tim Cook was not invited. Microsoft was not invited. Why do you suppose? Google was not invited. Can you believe that? Those three big, they were not invited with Trump. There's Jamie Dimon right there. I was just like, oh my gosh. It says, though there were conflicting reports about his presence. So the conflicting reports were that he flew over by himself on his own airplane. He flew over by himself, and he felt so bad he got left out, but he's the one who wouldn't let Trump put his money in his bank. Bank of America was not allowed in there. Berkshire Hathaway, Warren Buffett wasn't invited. Disney, of course, though Bob Iger wasn't invited. It's funny who wasn't invited. You know what's funny about Warren Buffett? Everybody's like, oh, we love Warren Buffett. He's so great. He is the one who is all against all the pipelines. He's the reason why all the pipelines got shut down. He's a big, huge donor to Joe Biden, and helped Joe Biden get elected with all the money that he gave him. And then Joe Biden got in there, and what was the first thing he did? Boom, shut down the Keystone Pipeline. Why did he shut down the Keystone Pipeline? Well, because Warren Buffett didn't want the Keystone Pipeline. Why? Because Warren Buffett invests in, I want to say owns, but he doesn't really own them any more than I own Apple. He's an investor. He invested. I got another story I want to tell you too. He's an investor who invests in all those. He owns all the railroad trains that bring oil over the border from Canada. So they bring them down on trains. He does not want the pipelines because that would take him out of business. He'll lose money. He owns all he owns all the trains. So that's why we lost our pipelines, is because Warren Buffett didn't want the pipelines. He wanted to still bring things in on train. And what's funny is because it's the Democrats that shut down the pipeline, and they're the ones that are all claiming, oh no, we're all worried about global warming, oil, and this is bad, and that, and transporting oil, and you're going to have big trains wreck, and we need pipelines. And then suddenly it's the Democrats that are shutting down the pipelines because Warren Buffett owns the train cars. The train cars wreck and the oil goes everywhere, and we have oil spills, right? Oh, now suddenly the whole table's flip. Oh, now the trains are the safe way. It's all politics. Don't listen to any of it. It's all a bunch of BS. Whoever's giving them money, follow the money. That's where we all know that. We all know that it's all a bunch of crock of shit. So whoever's got the deep pockets is who's driving the agenda at any given point. And that's why we're in this business, right? Because we're like sleuths. We got to figure this out. Right? So that's the Warren Buffett story. We all know the Bob Iger story. Because Elon was still palsy with Trump, and he was going, and he doesn't like Bob Iger because Bob Iger was giving him crap about advertising on X, right, on Twitter. So that's that whole story. Boy, there's a whole bunch of stuff in here. There's lots of funny stuff. Anyway, we could sit here and talk about gossip the financial markets all day long. I have another great story, but in the interest of time, I'll save that for another time. And we're going to close this down. We'll come back and start looking at the markets once again. Let's look at some charts. All right. Let's come over and see if any of you guys have any comments on what's going on. We got John out there saying hello. It's nice to see you, John. We got Kirk saying hello. I have my UBI data to share with you. We'll send shortly. Awesome. I'd love to see how your UBI is doing. I took some profits off. I feel like the markets are really overbought, way up there. So I peeled back. I'm going to do a little bit of rebalancing. I was going to wait. I got a couple more that I want to rebalance, but I want to get the dividends first, and then I'll rebalance those out. Let's go look at corn. Yeah, Kirk wants to go see corn. We're going to go look at that today. Jay saying hello. Kirk saying hello. So TDS is real, that's for sure. Yeah, Jay's going to come to our live classes down in St. George. That'll be fun. Be great to have you. I got my schedule finally. The third week of October is the first classes, Tuesday and Thursday. And then I think the very following week, the fourth week of October, we have 3 more classes. So it goes like Tuesday, Wednesday, Monday, Wednesday, Friday. Live classes in person at the university in St. George. So if you're going to rent an Airbnb and come and hang out with us for that 2 weeks and go see Zion Park and all that kind of stuff down there, that would be a great time to come and do it. All a big tax deduction because you're going to go get education, and the whole trip would be all a write-off and everything. So take advantage of those tax deductions, because you know what? Whatever IBM can write off on their taxes, if you have a small business, you can write it off on your taxes. And that's the rule. That's how it works. So if IBM can travel and write it off on their taxes, so can you. All right. So make sure you're taking advantage of those same big rules, those tax rules that everybody else does. That's what Donald Trump told Hillary Clinton, right? He goes, you write off all this stuff. And he goes, that makes me smart. All right. Let's come in. October it is. All right. It is October. I have a new RV just to come see you. There we go, Jay. All right, man. Bring your RV. Is it an RV that you live in, or is it an RV that you ride in the sand? Let's go sand riding. I can bring my motorcycle down, bring my 4-wheelers down, bring my side-by-side down, and we'll go ride in the sand. Or is it an RV like you park and you sit by the river and you put your feet up and you relax? It's one or the other. All right. Whatever kind of RV it is, I'm in. I like RVs. All right, let's get to business. We got to get down to business, do a little work here. All right, we got to make some money so that we can go play at Zion Park. Okay, what's the first thing we need to do? Let's pull up corn. Now, the thing is, I've been looking at corn, and corn is just going straight down. So we have to decide. I don't really want to buy some corn. Let's look at the weekly corn contract. And didn't I open it? I thought I opened it. My internet's been really slow today. There we go. That's the September. Let's bring up Christmas corn. That's what they call the December corn contract. Remember, contracts expire, right? So they expire in a specific month. And so the one that expires in December, they call it Christmas corn. All right. So that's the December. It's usually the most popular, most common traded. Now, notice commodities are one of these things that generally trade in long, sideways, neutral patterns. All right. Because if prices get too expensive, what happens? People stop buying them, right? Corn, for example, people stop buying it, gets too expensive. And now this is cattle corn. So this is the kind of corn that they feed to cows. This isn't the corn that you and I eat. It's not sweet corn. So they raise cattle corn and then they feed it to cattle, right? The cows. And so if it gets too expensive, well, they start feeding the cattle something else. They'll start feeding it wheat or grains, of some other sort. They'll start finishing them up. They'll feed them a lot of soybeans, soybean meal. Um, they do silage. A lot of you guys from Utah know silage. Silage is when they take the husks from the corn, not the corn itself, but the husks, and they throw it in a big pile and they cover it with plastic and they put tires all over the top of it and it goes rotten and it stinks to high heaven. So it goes rotten and then they take it and grind it all up and put it into little squares and then dry it out. And then that's what they feed to the cows. It's called silage. Sometimes they feed it the wet stuff too. Ooh, that stinks. I got down there in St. George, there's a little tiny cattle ranch, little cattle, just like a, hobby farmer. But he raises corn and he makes his own silage and he's not too far from my house, a couple blocks away from my house. And when he's making his silage, oh my gosh, you just better hope the wind's blowing not in your direction because it's a stinky bugger. But anyway, that's silage. So that's the name of the game, to feed these cattle, right? So when corn gets really expensive, they stop feeding them corn and they start feeding them something else. Now, wheat is something that's really popular, but mostly corn. They always talk about grass fed and grass finished. You know why they're grass fed and grass finished? Because corn's too damn expensive. And so in their marketing, they're like, well, why can't I'm not feeding my cows corn. That's too expensive. There's no way I'm going to buy that corn and feed my cows. So what they do in their marketing, they run around and go, oh, it's grass finished. That just means they were too cheap to buy the corn to finish them. Because we all love the flavor of corn and wheat finished beef. That's what we love. That's what makes them fat. That's when you get that big old steak and it's got all that marbling in there and you're like, oh my gosh, you just can't wait to cut into it because it's so juicy, right? Well, it's that corn and that wheat that finishes those cattle off that makes them so fat and juicy like that. So when they start saying, well, these are grass finished and so they're healthy, well, that means they don't have all the fat in them. They don't taste good. So if you want grass finished and grass fed and grass finished, it's because the price of corn was too high and they didn't want to have to pay for it. And so that's why they were grass finishing and grass fed, and then they try and make it sound like that's healthy. Of course, I guess, if you want to say that eating a big steak is healthy, but it's healthier because it's not as fat. And so they kind of use that as the excuse. But the real excuse is that the prices of corn were too high and they didn't want to pay for it. So they had to market what they had, which is cheap beef with a grass-fed, grass-finished. So now the price of corn's coming back down. But the point I was making is that commodities generally trend in. Now remember, this is the monthly contract. So each one of these lines is a year. All right. So each one of these lines is a year. So you can see, naturally speaking, this market generally likes to be in this trend. That's where it likes to go. That's the price of corn. And when corn leaves that, it likes to come back to it. All right. So because if it starts to get too expensive, the point is that nobody buys it. They stop buying it. And so that drives the price back down because it's a traditional commodity. And anytime anything gets too expensive, they stop using it and use something else, which then brings the price down. That's, standard supply and demand. And that's kind of very much of the patterns that we see in the commodities market. So you see that, all throughout time, going all the way back. Now we're going way back. This is 2007. Okay, and we got a little bit of a bump in here, and prices of corn kind of had that little jump right there. But they were staying very stable for a long period of time. This is why you don't buy corn on general commodities like you would like buy stock. Like oh, I'm going to buy Microsoft, and in 30 years, I'm going to be rich, rich, rich beyond my wildest dreams because it's just going to go up, 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 up over the next 30 years, right? This is why you don't do that with commodities, because they don't rise in price like that. They just keep going sideways forever. So we keep bringing this price of corn back. How far back you want to go? I mean, all the way to the beginning, right there. See that? So, so as this thing comes along, you can see every now and again we get these spikes. Come on, come on. Like there, and we get a little spike, and you can see it lasts about 1 year, about 2 years, and then it goes right back down into the channel. See that? And we come along a little big long shot for years. It just stays in that channel, Then suddenly we'll get a bad drought or something, no rain, and they get all worried and the price raises way up. But then it comes back down into the channel. And so then we get another little bump, and then, how bad is it? And then we got this little thing here that happened where we just kind of almost got a price correction. And it went, and this happened in 2006. Prices went up, and then they never did come back down to that price again. So then we got these, these big bumps here. But this is kind of the new price level right in here. And then it went in that new price level for 1, 2, 3, 4, 5, 6, 7 years. And then it broke out in 21. And then it's been way up here in 21 for 1, 2, 3 years. Now we're coming into 24. And then into 25. So now it's coming back down into the normal range, right? So we're back to normal range. All right. So that's where we're at with corn, sitting here in the normal range. And it's actually making a little bit of a fall. And you can see that in the range, it's almost dead center of the 50% level right now. So where's it going to go from there? Well, nobody knows. But there could be some additional downside potential. And that's one great big long downtrend with a little tiny ABC. I don't want to say that we're going to get a nice little Fibonacci projection off there and see it down into the 61.8. If it went all the way down into that region there, that would be putting it all the way back into the previous, time frame. See that? How it come right all the way back into this older range. Could it go down there? Yeah, it could. What's going on with the tariffs? The tariffs are making it so that we can now ship our corn overseas to more countries. We've opened up more countries, and we put a barrier on a lot of those other countries, make them have to pay a little bit higher price to get their corn in here. So technically speaking, you would think that it would cause the price of corn or something to stay a little bit higher, let our farmers make a little bit more money. That's the whole idea of tariffs, right? It's to have a little bit more competitive range so that our farmers can charge a little bit healthier price for them. But the price has already been so high. But it's naturally high. Their costs were running up too. They weren't having as much. We had bad weather situations, no water, so the corn couldn't, and that's why prices shoot up like that. So there's all kinds of things that can fundamentally derive why the price of corn is going to go up. Now, if we're going to try and trade this on a longer term basis, and we're not just going to scalp it, like Paul Golden for 8 seconds, which is really hard to do in corn anyway, because it moves so slow. Let's show you. We'll bring it down. Let's just come down to a 2-minute chart on corn. Is it still open? I don't know if it's still open. Let's look and see. I think corn's been closed. Opens at 6 p.m. and closes at 12:20. So we're a little bit late to see corn. All right. But you can see from here, that was 9 o'clock in the morning. That's 12, 9, 10, 11, 12. So that's a 3-hour time frame. So in 3 hours, that's how far it moved on a 2-minute chart. Can you trade that? Yeah, you could certainly trade that all day long. You could sit there and trade that nice little trend. And the nice thing about trading corn on a longer, that's why I don't do a whole lot of that in our little 1-hour meeting, because we've only got 1 hour, and you have to sit here for 8 hours to get just that much of a move. So corn moves slow, but the nice thing about trading the commodities like this on a longer term basis, 2 minutes, it's not a long term basis, but I mean, this is what I truly call day trading. All right. Because you guys know me, been here with me for a while. Day trading is when you come in and you trade like this. You're going to try and stay in the trend for as long as you can throughout the day. Now, you might want to try and get in the morning, and you want to be done by the end of the day and get out by the end of the day. So you're going to only make 1 or 2 or 3 trades all day long, and you're going to kind of sit here and monitor it, or use the automated tools to help you to make your trades. But the point of the fact is, you're going to try and trade in the market all day long and only make a few trades, 1 or 2 trades all day. That's day trading in my book. Now, the other type of trading like we do usually, where we're in the market for maybe 6 or 8 minutes at the most, that's got mold on it. If we're trading like the general markets, we're trying to make $500 a day just trading on those other markets, right? I call that scalping. All right, so that's scalping. To me, that's scalping. And then this is day trading. Now, you go out on the YouTubes and everybody's going to call it something else. So for us, we have to have specific terms, and the specific terms that I use were the ones that I learned 25 years ago at the Chicago Board of Trade. All right, so we got scalping, very short term. You're going to get in and out very fast. Paul Golden style, 8 seconds might be your trade. All right, that's a scalp. If you're in at 2 minutes, that's a long scalp. And if you're in at 5 minutes, that thing's got mold growing on it to be a scalp. You're starting to move over into day trading time frame. So we got scalping, we got day trading, and then we got position trading. Position trading is when you're going to hold it overnight for a longer position, right? You're taking a position in the market and you're going to go position trade. Swing trading, people get those two confused. They think swing trading and position trading are the same thing, and they're not. Swing trading is a strategy. It's not a length of time that you're in the market. The lengths of time are scalping, very short. Day trading, you're going to only be in it 1 day, but you're going to try and trade the entire day with only 1 or 2 contracts. You're not jumping in and out all the time like you're scalping. And then position trading, where you're going to try and take a long-term position and you're going to stay in it longer, multiple days. That's position trading. Swing trading is what people get confused with position trading. They start saying, oh, I'm going to swing trade. And to them, that means that they're going to stay in for a long period of time. No, swing trading is a strategy. I'm going to swing trade. Think about, you go to the park and you get in a swing, right? And you hold on to the swing. It's got little chains. You're swinging. What are you going to do? You're going to go back and forth, back and forth. That's a swing. So that's why we use swing trading. When you swing trade, it can be done on any time frame. And usually when we're day trading, going for a longer term trade, we're going to swing trade, because we're going to take every long, we're going to take every short. We're going to swing up and down, up and down, up and down. So you can swing trade on any time frame. It doesn't matter the time frame. Swing trading is a strategy. It's not a length of time you're in the market. So if we here in this class can establish that as our terms, when I say, oh, we're going to swing trade, you know what I mean. You can say, well, he's on a 2-minute chart. He's going to take every buy signal and he's going to take every sell signal, or he's going to weed out the sell signals because he's in a downtrend, and weed out the buy signals and only take the short sell signals because he's in a downtrend. When it goes into an uptrend, he's going to weed out the downtrends and only take the uptrends. All right, but that's a swing trade. Swing trade is you're going to use the buy sell signals, buy sell, buy here, right? We got buy here, sell here, buy here, sell here, buy here, sell here. So you're going to buy, sell, buy, sell, buy, sell. You're going to swing back and forth. And it can be on any time frame. On a 2-minute chart, you're going to swing trade a 2-minute chart. Now you can take a position in a market that's out on a daily chart and still swing trade it, because you can be on a big long uptrend, and then when it turns short, you're going to reverse your position and go short and stay in it for another 3 or 4 months going back down. That would still be a swing trade. It'd just be on a longer term position trade chart. All right. So if we can all use the correct terminology, it makes sense, and we can all talk the same language. But when one guy's calling one thing swing trading that is actually position trading, and another guy's calling day trading something that's actually scalping, everybody gets confused and we don't know what you're talking about. And so anyway, pet peeve. All right. Everybody knows my pet peeve about that. I like to have things known. All right, so if we're going to take corn and we're going to go for a longer term time frame, the reason corn is one of the most popular day trading tools is simply because it doesn't take a lot of money to get into it. You can see you can trade, you can do a day margin, you can day trade it with $579. Now, this isn't even the mini, this is the regular contract. You can see it's 5,000 bushels. All right, so we're looking at the 5,000 bushel. This is the December corn contract. This is the one I traded forever. This was kind of my go-to. I traded corn. That's the one I kind of cut my teeth on. And when I first started trading, corn was probably my first ever real money trade. And so corn is kind of the one that you start with when you day trade commodities. All right. So that's what we look at on corn, and realize that the market, you want to always be very mindful of the longer term trend in corn. And you want to also be very mindful of where it's at in the longer term cycle. All right. So you can see we're down here in the bottom cycle. But the fact is, when we're day trading, it's more important to look off of the day chart and see where we're at, and then do your Fibonacci projections and anticipate a continuation of the downtrend, the drop in the market. Count and measure, do your measurements from high to low, and then do your Fibonacci projections. And you can do that with any number of tools in here. And I'm not going to go into great detail in the strategy, because this is it almost doesn't matter whether you're trading on a 1-minute chart or a daily chart. The strategies are the same. We're still going to count and measure. The markets are fractal, meaning they go through their ABC patterns on a daily chart, just like they do on a 5-minute chart or on a 2-minute chart or on a 1-minute chart or on a range bar chart. You have ABC patterns, and we're anticipating these markets moving in these reflective ABC patterns. And the reflection that I'm talking about is that markets have a tendency to move. If it moved in one direction a certain distance, so for example, it rallied up and then it fell this far, and then we would anticipate that the rally up from here to here would be about the same as this rally up here. So that gives us this little ABCD pattern, right? So we have these little tools in here that we can use to show us these little ABCD patterns. And then, of course, that's where you guys are familiar with your Fibonacci bow ties, and we get our bow tie tie-offs. All right, so we use areas of support and resistance, and then the neutral zone, or the middle zone, as our tie-off points and our previous highs and lows. And then we just look for the next little pattern to do the same thing. We look for the next one to come down, and then a little rally, and then a little come down, a little rally, a little come down, a little rally, and then a little come down, a little rally, right? And we generally anticipate that these markets are going to make, overall, in the longer term scheme of things, drive 1, drive 2, drive 3. And I get the wrong tool again. Come on, Lan. So we try and find the high, and there's the high. I got to turn off that auto scale. That always screws me up. Sometimes it's good, but I think it should be the other way around. The thing, I don't know. Heck, I don't know. Just don't ask me. It comes in here, and this thing you're going to try and identify whether you're in an uptrend or a downtrend, right? And how far that uptrend and downtrend is going to go. And that's the whole name of the game. You're just trying to count and measure, and you can use your bars. You can say, well, last time it went from this low to this high, from this high to this low. Let's go from this high to the next low. Is it anywhere close to the same number of days? So this was 27 days from this high to this low. And then it went 23 days from this high to this low. And then we go from this one, and we do this in the commodities market all the time. We like these timings. So that's 27 days again, from this high to this low. See, that was 27 days. This is 23 days, 27 days. Then we got this high, and we're going to go out to the next low, and that's 24 days. We might get 2 more days down, 27, and then we'll look for it to return and come back up. You did have a little smaller one in here, a little ABC pattern that was a little shorter one here, which was 11 days. We had that same little cycle right in here, which was 8 days. We didn't really get one here. Well, it was right there. So it was just 14 days. And then we got this little cycle right here, which was 12 days, 11 days. So you can see the mini cycle in there, little ABC, the fractal ABC. It was about 12 days, 14 days, 12 days, 11 days. The longer cycle was 27 days, 23 days, 27 days, 24 days. So you can kind of get these little cycles and trends going in these markets. And then we're looking for the overall longer term trend altogether. So there's a nice big drive 1. You got your counter trend. I don't know. That looks like 4 drives to me, but that's drive 2 down. You get a little counter trend in here, and then we get this drive. Looks like drive 3 right there, counter trend. And this, I was getting a little breaking down in here, but it almost looks like our 4th drive right there. And if we look at the longer term trend, it looks like to me we should be just about at the bottom, right? We should be just about down here where corn should kind of bottom out down in here. We don't have a lot more downside to go. It doesn't mean we can't. We certainly can. It looks like to me we've got the little ABC on the longer term time frame, and we got some downside potential. So our bias is still down. But on the shorter term time frame, we got 24 days in here, and this is 27, 23, 27. We'll have to wait and see because we'll probably get another little 11-day rally or 8-day rally coming in here. So we get a little pullback here, and then that'll be the question will be, are we going to be at the bottom, and is it going to give us a little ABC pattern down in here? But that's the daily time frame. So if we feel like we maybe have 1 or 2 days still with a downside potential, or if this is going to be the reversal, we would come down to maybe our 2-minute chart tomorrow, and we would start trying to anticipate where that chart's going to go. Now you can do you can come in here and you can do the smaller time frames too. I got a student who uses the range bar 6 to do his position trades. All right, so this is what he does with corn, and he'll be in the same market for months on a range bar chart for months. All right, and he does very well. He's actually a farmer, and he actually raises corn, and this is how he trades. He calls me all the time, and we talk, and we look at his charts, and he trades the corn markets, and he gets in on these range bar charts, and he'll stay in them for months on end on a range bar 6 chart. That's what he likes. Usually if I go out to a longer term time frame, I'll start, and I try to get him to do it, but he doesn't like to. He likes to stay on that range bar 6. But I like to start down on a very short time frame. So we'll go down to the range bar 6. Once we get into the market, you get your position on, you bring your stop to break even, right? And don't bring it too quick. You're not risking a whole lot of money. These are small markets, especially here on the range bar 6. So it's not a big risk. And then you can get yourself into the market. Once you get yourself in the market, bring it to break even, and then just leave it there. And you got to, you want to work out the strategy. The nice thing about the commodities like corn and wheat and soybeans is when you day trade like this and you're in the markets, once they start to trend, they usually stay in the trend for quite a while. They'll stay in that trend for a good. You can see, like, just this little downtrend here. That's a $400 move. But you can see how long was it. Take this. Where's our little calculator? Where'd it go, Lan? You're just using it. So this is how many bars. This is a range bar 6. That's 1 day. That's 17 hours and almost 18 hours. 24 bars, 18 hours. So that's 2 days. So the point being that once you get in, you can leave your. Let's say you got in here and you just brought your stop to break even, or you even just left it right where you put it in. Let's say you get in right here. Let's say you get in right here, and then you put your stop right here, and that's it. That's your trade. And you can just ride it down as far as you want, right? Until it really starts to look like it's going to turn around, gives you a little ABC bottom formation, and then you can take your profits. But you can see from just where you get in, maybe right here, down to where it's currently trading, that's $825, and that's in how much time? We take that bar from there to here. Let's go all the way to there. That's 9 days. So you could ride that whole trend down for 9 days and just sit on your contracts and just ride them out. Now, if you go over the 1 day, right? Because if we come down and we go to the range bar, we go to the 2-bar chart, and you go to the key, you're going to see that if you keep it overnight, and your overnight is the open and close of the 6 o'clock to 12 o'clock. If you keep it over that, they're going to take you up to your maintenance margin or your initial margin. So you're going to have to go from $579 to keep one contract up to $1,158. It's double. All right. So keep that in mind. You're going to have $1,100 to keep it in the market for a long period of time. And so multiple days. And then if you have it for 2 days, if you keep it 2 days, which in that last trade we would have kept 8 days, this margin amount goes down from 1,158 down to 1,000. That's what that means. All right. So you go from 1,001, you go from 579 the first day for day trading. You keep it overnight. The very first night you go overnight, they're going to take you up to 1,100. And you keep it a second night, they're going to take you back down to 100 or 1,000. So they're going to drop them roughly $100 off, $120 off. All right. Now, the whole idea here, now remember, when you're trading in the commodities market and you're trading corn, how much corn are you trading? Well, remember, 579 or $1,000 is only it's like putting it on layaway, right? So it's only like a 10% down. You're actually controlling $5,000 worth of corn. All right. And in this case, or 5,000 bushels. So 5,000 bushels of corn is what you're controlling, but you don't have to put up all the money for 5,000 bushels of corn. One bushel of corn is $4,000, or it's $4. So if you're going to have 5,000 bushels of corn, what's 5,000 times $4.02? 4.02 times 5, 1, 2, 3. That's $20,000. So you only have to put $579 to day trade a $20,000 contract of corn. And just for interesting sakes, 5,000 bushels is how many bushels of corn fits in one train car. So every train car that goes by full of corn has 5,000 bushels in it, and that's one contract. One contract is one train car of corn of 5,000 bushels. And then every time you put up $579, you control one train car of corn. If you put up another 500, you put up $1,000. Now you got 2 train cars of corn. Now you got 3 train cars of corn. Now you got 4 train cars of corn. That's what you're doing. You're trading train cars of corn. But you don't have to put up the full $20,000 to trade one train car of corn. Why? Because it's got a date attached to it, which in this case is our Christmas corn. So it expires in December, meaning you don't have to, if you buy it, don't have to take delivery until December. And if you sell it, you don't have to make delivery until December. Well, the price of corn could go up. You could buy it today and you don't have to make delivery of it, or you could take delivery of it till sometime in the future. So you could just offset your position before you have to make delivery, and you make the difference between what you buy it for and what you sell it for before you have to make delivery. That's why they let you do it this way. All right. Because you're just basically putting it on layaway, put up 10% until you have to make delivery. If you're going to buy it, you're going to take delivery. So if you put up 10%, you put up 500, and then the next day you put up 1,000. So you put up $1,000 to buy one train car of corn in December. Does that make sense? So in December, you got to take, and then that's when you have to pay the remaining $19,500 worth of corn, because you bought it today when it's worth $4, $20,000 for one train car of corn. You said, okay, I want to buy one train car of corn. But because you're not going to take delivery of it till December, they don't make you pay the whole thing today. They just make you pay 10%. And then you pay 10% for your train car of corn. And in December, if you don't sell it to someone else before December and you do actually take delivery, because there are some people who want to take delivery, now they've paid $1,000 towards their $20,000. Now in December, all they owe is $19,000. And then they get their corn and they can go feed it to their cattle. That's how it works. But you're like, well, I don't have any cattle land. I don't want to take delivery. Well, don't take delivery then. All you have to do is, if you buy it today, you sell it before December. Hopefully you sell it for more than you bought it for. And if you do, you make money. If you sell it for less than you bought it for, well, you lose money. And that's how the commodities market works. All right. So that's why we have contract expiration dates. So we can come in here and we can come down, we can go into the September contract. So now we're going to come over to September. And now this one expires in September. So if we come down to a 2-minute chart, it's going to be basically roughly the same pattern, right? So we're going to big rally there coming in towards the end. Now this rally started at 11:18 on 8/6. So that was today at 11 o'clock. And it ended on the close of the day. So all the way to there, that was $175. And it was 14 ticks for one contract. So our one contract rose in price. And I tell you, when these markets start to move, they kind of stay in their trends. So they're a little bit quiet. They're a little bit choppy. See how they come down here. If you're using that yellow ATR dot, you might want to tighten or loosen it up a little bit. It doesn't need to be quite so tight. Put it at one. Start with 1 and 1, and you can just trail it. We can turn off the blue light altogether if you want to. Just turn. Don't confuse things. All right. Keep it simple. Just the average true range, and just kind of watch the markets and see where they go. Once they start to trend, they have a tendency to just kind of stay in the trend, because that's the nature of these commodities, and that's why they're so popular. That's why, a lot of people like to trade them, because once they start to trend, they just kind of stay in the trend, and you just kind of ride with them. And you're not making a whole lot of money on one contract. You're putting up $1,000, you're making $175. That's not bad money. I mean, that's pretty good money. I mean, if you want more, well, put up $5,000. Buy 5 contracts. But it's all on the risk of entry, right? How much are you willing to risk to find out if you're right that the market's going to rise? Right? You get a little yellow arrow, or how much are you willing to risk to find out if that market's going to continue to rise? And the distance between, those bars you can see in here, if we come in here with our dollar calculator, let's say you decide to get in right here, and you're going to put your stop back behind these low bars right here. That's about $25 right there, and that's all the way from the one dot to the other dot. So you're risking $25 per contract in this situation, right, on the September corn. Now, the volume's pretty low on this. I think you're going to want to probably trade the December corn, though, because that's where everybody's at. 4,000. These are still pretty. This is 3,000. So you can see it's December corn has more volume. You're going to be better off over here on the December corn. But the volume's pretty low on these anyway. You have to just keep in mind that you're going to get a little bit of the spread is going to kind of eat you a little bit. So we're going to come in here to ATR. Let's raise that up to 1 to 1. And let's just say we got in right up here, and we put our stop right there. That's still $25. So you're going to risk $25 per contract. So you're going to risk 25 to make 125 in this case, right? Well, it actually went all the way up there. It's still up there. It's up $200. So you're going to risk $25 per contract to get in. You put in 4 contracts, you're going to risk $100 to get into the market like that. Now that's crossing over on the ATR set at 1 to 1. That's how you trade corn. That's why corn's popular for beginning traders. Now they've even got a micro corn. You can go in, they got a little tiny corn. Watch this. You can come in here, and you can go in, and you can go up here. You come down to corn, and see they got a mini corn right there. So if you don't want to trade the regular size corn, you can trade mini corn. So there's mini corn, and mini corn, if you come over to the key, you can see controls 1,000. Contract size is 1,000 bushels. That shows that in dollars, but that's contract sizes. It says $1,000. How many bushels? This is the bushels. It's 1,000 bushels. That shows us a dollar sign. Oh, maybe it's because it's $1 per. I don't know. It's 1,000 bushels versus 5,000 bushels. So it's 1/5 the size. All right. So as we come in here, this is your little ABC patterns that you're trying to follow. All right, your little ABC patterns. And we're just getting little ABC patterns in here. And that's all we're trying to do. We're just trying to get little ABC patterns and see where these little patterns are. They're breaking in here. So you got to be mindful of that. But that's kind of what you're looking for. So it gives you just a little bit of an idea of which direction you should take on the shorter term chart. So then when you come down and you go into the minis, let's go back down to the 2-minute chart again. Look how the volume's just really low. So not many people trade the minis on the grains, and the reason is because the regular contract is already pretty tiny. All right, so this would be really tiny. So this whole run from this low to this high right here, that's $52. But the key says you'd only have to put up day margin is $231. So if you're really scared and you want to you can start really tiny, but just be mindful that you're going to get some pretty bad slippage in here. The spread is probably going to be pretty wide, and to be able to get that money out of there is going to be tough because the spread's going to be so wide. You probably just want to, just stick to some of the other markets in the micros are okay, or the minis, like crude oil. If you're going to go trade crude oil, so let's pull up crude oil. So we come over to crude oil, and we're just going to do there's the NYMEX. Now this is like the full size contract. All right, let's show you from here to here. This is like from there to there. That's like $6,000 move. And if you go to the key, you see day margin is 3,000, and then the initial margin overnight is 6,800. So you have to have $7,000 in there. You're going to risk quite a bit on that. Now, scalp this one, right? It'd be a good one to scalp. If you want to come and scalp, we can come down here to the 2-minute chart. Let's take a look at that real quick. And I like to trade crude oil. Crude oil is a fun one because, well, once you get into the trend, it kind of smooth and kind of stays in the trend, and it's a lot of money. So, if you take a small risk, it gets into a situation where it's breaking those yellow lights, or the risk is not very big, because if it comes back and stops you out on the yellow light, it's just a small position. But if it goes, and you know me, if it doesn't immediately go in my favor, I just get out, because I'm not going to take a big loss. So, but if it immediately goes in my favor and doesn't cross back over my yellow dot, I'll stay in that market as long as I can get that thing to break even, and then let it go until it crosses the yellow dots. And so you can catch these little trends like that. You can see that $670 in, let's see how long that is. And that's a bigger contract, right? You're not trading the micros. That's 13 bars. Can't see how long it is. 25 minutes. All right. So that's $670 in 25 minutes. And that's a day trade. So it was with, you have to have $3,443 to put that on. So the risk, you want to just be really careful with your risk. All right, making sure that those dots and the entry point are really close, and it's moving in your favor. So it's immediately going in your direction, and your risk is really small. If it does come back against you, just get out with a tiny little loss. And even a tiny loss in this market can be big. All right, so we're going to come down and we go to the mini right here. And this is a fun one here. So this is the one I like to trade. I don't trade the big one. I trade the mini. So the mini, and you can trade the micro in this one. Let's go look at the micro, but let's first draw a dollar calculator on here, just from here to here. See, that's $6,000. That's on a daily chart. Let's go down to a 2-minute chart. I like the Heikin-Ashi. So that's the same thing we were looking at. So you can see in here from this chart to here, that's $300. So, and then the other one we'd go down, it'd be $30. It's going to pull up the micro, and it would be, I think, $30. So that's, it's the same thing what we're doing when we're doing the minis and the micros over on the indexes. You have minis and micros, and that's how we do it in the futures market rather than leverage. We just say, well, we're going to trade the mini, and we open up the mini chart. Oh, we're going to trade the micro. We open up the micro chart. Oh, I'm going to trade the full size. We open up the full size chart. Rather than some platforms, when you, like in the olden days when we did Forex, they would have a calculator, and you'd put in, I want 2x, I want 3x, I want 4x, and then you just stay on the same chart, and all it would do is change your math of how much you were buying and selling, which was a pretty cool system, I have to admit. But that's not how we do it in the futures market. Futures market, they do it all for you, and it's set up. You can't sit there and, oh, I want to trade more, less, and just stay on the same chart. It doesn't work like that. You do 1 contract, 2 contracts, 3 contracts, and then the different sizes are based on the different contract sizes, which are different charts. So you open up your different chart. But again, you still have your September contracts, you have your December contracts. All right. So if we were to come in here and say, well, I want to trade this as this market's still open. So we come in here to the key, closes at 3 o'clock. So we got 1 more hour on this one. So if we wanted to take a position on this, we'd come in here and say, well, I think it's on its way up. The problem is, see how wide that spread is. So we want to widen this out just a little bit, just to accommodate that wide spread. And when you do that, you have to trade both sides of it. And remember, and that's what makes your risk more expensive. So you could come in here and you just drop this in here, and we're going to go stop. Did you guys notice they gave us more buttons? The new version of the software. I don't know if everybody has this. This is a beta version. Some people I know are on the beta version, but now you can see I've got 6 QOCOs, and you just can add more and subtract more with this little buttons over here. So I'm really happy. I've been begging for that. Clear back when I owned the company, I wanted that. So now we're going to come in here. We're going to trail the ATR. And this would be a reversal. This would be catching, if the market turns and falls, we would intercept the order to the short side. All right. Or if you wanted to, you come in here and say, well, I think it's going to continue to rally for the next hour going into the close. Okay, well, then you can just go ahead and hit buy. Now you're in the market, and you've also got your trailing stop. So either way you want to play it, it's the same basic strategies that what we do when we're day trading over there on the futures market, when we're trading the indexes, right? It's the same strategy. It's just being done on a longer term time frame on a different market that moves a lot slower. So, not quite as aggressive, not quite as fast, not quite as crazy. Once you get in a trend, you let it go. If it doesn't go, you get stopped out, take a loss, and you do it again. This is the mini, and this is a single contract. You can see we're not taking a huge risk here. if we get stopped out right here on this reversal, we could actually reverse this. They don't let us change that anymore. We have to do it with 2. So now we're going to come in here and go stop, and we're going to put that in there, and we're going to go edit, and we're going to drag that thing in, and we're going to go trail on the ATR. That would be a reversal position. So if we get stopped out, we'd take our small loss, and then we'd reverse our position and take another short position off of there. That would be a trailing with 2 stops. So it would reverse our position. But if it continues to go, well, it trails up and you make money as it rises. If it reverses, it just takes you out of the long position, puts you in short, and then you ride it short. And where this kills you is if it keeps going back and forth and back and forth and back and forth, which, sometimes when these markets are quiet, especially after hours. This is kind of after hours trading because the stock market's closed. So the stock market's closed, so this market's going to slow way down. Even though it's still open, it's going to slow way down. Traders kind of follow the stock market open and close, even though these futures markets are still open. So you can see how slow they go. And so this is why I don't do a whole lot of this in our afternoon class. We mostly just do scalping because I can teach you the same concepts, how to put the orders in and how to set them up automatically with the OCOs, and the markets move a lot faster when we're over on those indexes in the last hour of the day. It doesn't mean you have to trade those indexes with those strategies. You can come over here and trade, crude oil on a 2-minute chart using the exact same strategies as we learn over there. It's just that they go faster and we can see more examples. Over here, it's pretty slow, pretty quiet. It's kind of like watching cold tar. No pun intended. Actually, pun intended. It's like watching cold tar. All right. I'm going to kill that one. Exit chart. We're out of our crude oil position. Let's go over and corn. Let's go look at the NASDAQ real quick. See what it did today. That's the 1-minute chart on NASDAQ. This is the after hour. So market just closed. It's pretty dead all today. So probably kind of a good thing we didn't come in here and try and trade that because we'd have got our heinies handed to us. I don't know. Maybe if we were just doing a little scalping strategy, might have pulled a few dollars out, but probably not. We'd have probably got our heinies handed to us. All right, guys. I don't know if that helped. I know a lot of people were asking, how do we trade longer term time frames in the futures market? So that was just a little quick introduction and the best way to get started in some of these markets. There's lots of markets in there. You can go take a look at all of them. I like gold. Lean hogs is even fun. Some guys like to trade the currencies. I used to trade currencies all the time. When I was running my business before I sold it, I had a platform for trading currencies, futures or Forex. We didn't trade the cryptos. Crypto's something different. This was just the foreign currencies. And I had a whole platform just for foreign currencies. Now they still have the platform over there. If you wanted to go trade it, you can contact them. They'll let you trade it. But they've kind of legacied it. They don't really want to push the Forex market anymore because all the currencies ended up over here in the futures market. So you can trade all the currencies over here anyway. So it's like, why have 2 platforms that do the same thing? So they kind of legacied the Forex version and they just kind of focus on the futures version, which is better anyway, because the Forex version, I could get into a lot of stories on that. There's a lot of problems with it. But having the currencies go through the exchanges is a lot better, a lot safer. So now you can just trade the currencies over here in the futures market. And so there's no reason to run the Forex market. I don't trade as many currencies as I used to when we were doing all the Forex trading and I was creating the Forex platform. I did a lot more Forex trading. I don't do it so much anymore. I love the indexes so much. I just mostly trade the indexes, and every now and again I'll go over here and trade crude oil and gold and sometimes corn still. I don't trade the grains as much as I used to, wheat, but I got some buddies who like to do that. Mark Peterson likes to trade some of those. So we go look at those together once in a while. But mostly, I kind of stick in the futures market to trade in the indexes. That's kind of where I like you find what works for you and you just kind of stick with it. It's like I was saying before, you can do financial entertainment and go chase around and do a whole bunch of crazy stuff. But if you think about it like work, this is just work. You just come to do what makes money and not try and make it be entertainment. This isn't your video game. If you want a video game, go play Sony PlayStation. This is work. You're coming here to make money. And for me, if I just want to come and make money, the easiest place for me to make money is in the indexes. So that's why I spend most of my time in the indexes, because It's where it's work, I come make some money and do it in the indexes. If I want to play and go have some other fun and some of these other markets, those are some of the markets that I like to play in. Soybeans are pretty good. They've got pretty good, soybeans have pretty good volume. And so you can play the soybean market pretty good. Where did it go? Soybeans. Oh, there it is. Soybeans. August, November soybeans are usually the big one, not the December. So when you're trading soybeans, look at the November contract. So you got kind of your little 3-drive pattern there. You can see that already, right? Little drive 1, ABC. Then we got another one, ABC. And so it's coming down. You got your drive 1, drive 2, drive 3. So we're kind of approaching this lower region. You can see the volume starting to fall off down in here. So that means we're probably going to be looking for a reversal. Little projections come down at 137. 130.9 is our golden ratio. So if we come in there and oops, I hit the wrong button. Where'd my soybeans go? There they are. I want to come back to soybeans and I want to bring those down to 2 minutes. Of course, I think this market's closed too, right? Because it closes at 3 o'clock along with crude oil. So it's still open. We got another hour in that one. So there you go. You can see it's pretty slow. It's a pretty slow market, pretty quiet. But you think it's going to continue higher right through here? Very easy. You just come in, you hit buy the market, and then put your stop in there. Drop it in, edit, tell it you want it to trail on the ATR, hit OK. That's it. That's all there is to it. You just let it trail up till it gets to break even and then let the rest of it go, or continue to trail up on the ATR and little yellow dots and let it go till it crosses the yellow dots. Either way, but you can see it's just a little bit slow, and the spread is a little bit wide right now. But it moves kind of slow. That's the two-year Tino. How did I get over there? Not on the. How did I make that mistake? Oh, my mouse skills are really bad. Let's do it over here. I got a new mouse. Look at my new mouse. I got one of those gamer mouses. Look at that thing. And if you look at the bottom, it's got like all these weights on it. Because I was like having so many problems with my mouse. You guys know my mouse was freaking out on me all the time. So I need a new mouse. These little $5 mouses are driving me crazy. So I got me a whopping $35 mouse. So it's a really expensive mouse. And I like the cables. I don't get the battery ones. I can't stand the battery ones. So I always get the one with the little tail on it. But it weighs a ton because I put all the weights in it. Why'd you put all the weights in it, Lan? Well, I don't know, because I never had a mouse with weights in it. Didn't know what it was like. So it's a really heavy mouse now because I put all the weights in it. But I think I kind of like it. I don't know. Look at this market. That was a really nice move. What time did that start? 7:46 a.m. So that was first thing this morning. And then this market just tanked. How much was that? From here to here on the soybeans, that was $525. What would your risk have been? Well, if you'd have got in on here, just on the first break, from here to here, you'd risk about $112 probably. It depends on where you got in, but let's say you risked $100 and you made 525 trailing that thing down. Now look at how close the ATR is. Let's make sure we're not too close, because we got to give room for that. Got to give room to the spread. Are you going to get nailed? You might want to use a little bit further out, maybe those blue lights. You trail this thing too close because the spread goes a little bit wide on these markets, especially when you're down on the 2-minute chart or something. You might go down to soybeans. We'll do a 5-minute chart. I don't have 5 minutes here. We're going to go to change that to a 5-minute. Oh, I got 2-minute charts. That doesn't make sense. Make that one a 5-minute chart. How come it's not switching? Come on. Come on. Bring it up there. Bring it up. Why is it not bringing it up? I've been having my internet or something. It's been really slow today. I was noticing that earlier when I was trying to open charts. That's the 2-year T-note. That's the one we're worried about right there for our S&P 500. Yeah, I'm getting ready to do some rebalancing. So I got some money sitting on the sideline. I want to rebalance. But I need a little bit better pullback on some of these markets. Soybeans. 5 minute. There it is. It come up. Okay, so there's our 5-minute chart on soybeans. That makes it a little easier, doesn't it? Makes it a little easier than the 2-minute. So again, from here to here, that's $600 just right out of the opening gate. And you risked about $100. I think you'd get away with a little bit smaller risk, but I say you risked $100 for $600 on that move. That was a pretty nice move. Market's closed. That's why the spread's so wide right now. Closed at 12.20. But it opens right back up again. So where's yesterday's open? 7 right there. There's yesterday's open. So yesterday it flushed down again like that. Maybe just take the first move right out of the gate, down $275, single contract. How much a contract over here in soybeans? $1,182. If you keep it overnight, it's $2,365. All right, guys. You guys have any questions about trading the futures market? Day trading the futures market. It can be fun and it can be good because it's slow. If you got time and you're not in a hurry, if you're not an A-type personality, maybe if you're a B-type personality, you can, things move a little bit more slowly. You're not so anxious all the time. And you want to do a little day trading. These are good markets for that. Okay. All right. There you go. That's how it works. And if you don't have any questions, I'll let you go. Let's come over here and play a little bit with our assets. Let's come over here. Which one do we want to see? This one here. We better start off with this one. Then we'll do some more fun ones.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that's where you go get your software to do what we're doing here. And, of course, we got to talk about Pitt News Magazine.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, that's it. That's what I got for you. We all know this guy here. This is fun to play with.
Yeah, of course. I have a lot of subscriptions for magazines. My most recent subscription, I picked up a lifetime subscription to Pitt News Magazine as an example, among others as well.
Yeah, we would never use AI to get celebrity endorsements. Not here. We would never do that.
Yeah, when I heard Elon talking about Pitt News Magazine, I called in and got a lifetime subscription, myself, of course.
And we would never use AI for anything.
Hey, Lan Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
And we'll have to leave with Claire's. We'll take this on her podcast.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right, there you go, guys. I hope you had a good afternoon, and we'll see you tomorrow morning, bright and early, 8 a.m. And we're going to go through our portfolio again, and I'm going to see if I can't show you some of the things I'm doing as I get ready to rebalance my portfolio and look at the markets together with me and see why I'm pulling all that money out of the market in anticipation of a pullback so that we can have another opportunity to get back in at a lower price. Dollar cost average our money down, and not taking it all out, but taking a chunk out so that we can rebalance. And I'm going to try and do a rebalance. All right, with you. And we'll talk about that tomorrow morning, 8 o'clock a.m. We'll see you then. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.